Welcome, everyone. I want you to imagine locking in a nearly 10% real return on your money. And I mean actual wealth building progress after inflation just by moving your capital across a border.
Oh, wow. Yeah, that sounds almost too good to be true, right?
Exactly. Meanwhile, the world's biggest economy is offering you like less than 0.5% for the exact same privilege. It honestly sounds like a glitch in the global financial matrix.
It really does. But to understand this glitch, we're diving into a massive data poll that was conducted just a couple of days ago.
Yeah.
That was on Wednesday, April 29th, 2026, at exactly 09:00 Brasilia time.
Right. And today is Friday, May 1st, 2026. And the numbers we are looking at are honestly actively shifting the tectonic plates of the global economy. I am your host, and as always, I am joined by our resident expert to help us translate the math into reality.
It is fantastic to be here. This is, exactly the kind of macroeconomic puzzle that reveals so much more about the world than just a few numbers flashing on a screen.
I completely agree. You are tuning into Macroeconomy AI, and today's specific deep dive title is Real Interest Rate Differential Between Brazil and the United States.
It's a heavy title, but I promise the mechanics underneath are fascinating.
Definitely. Before we jump into the deep end, a massive thank you to all of you out there for joining us. We absolutely love unpacking these complex topics with you.
We really do.
And a quick word about our sponsor, Channel. Macroeconomy AI is bringing a compilation of analyses and news on macroeconomics, technology, and artificial intelligence. So make sure you subscribe to keep your finger on the pulse.
Right. Now, to set the stage properly, the mission of today's deep dive is to unpack the hard data from a newly released report. It's titled Spread Real Juros Brazil UA 2000 6 2025 ABA 2026.
That's quite a mouthful.
It is, yeah. But our goal here is to understand the structural dynamics of this massive rate gap. But before we look at a single data point, I must explicitly state right up front, none of this discussion constitutes investment advice.
Good disclaimer.
Yeah, we are simply analyzing macroeconomic trends and historical variances, nothing more.
Perfect. So let's start by demystifying the basic jargon. Before we get into the heavy math of the report, we need to understand why this spread actually matters to anyone, living in the real world.
Right, because it impacts everyone.
Exactly. And I like to think of it using a treadmill analogy. Think of a nominal interest rate, the headline number you see on the news, like the speed you are running on a treadmill.
Okay, I like where this is going.
So you might be sprinting at a speed of 10 on the dial, putting in a ton of effort, feeling really great about your momentum. But inflation is the speed that treadmill belt is moving backward against you.
That is a highly effective way to visualize the mechanics of capital, because the real interest rate is your actual forward progress relative to the floor.
Right. If you are running at a speed of 10, but the belt is ripping backward at a speed of 9, your real forward progress is only a speed of 1. You're exhausted, but you are barely moving.
What's fascinating here is that looking merely at headline nominal rates is, well, it's the ultimate rookie mistake in economics, and yet it happens constantly.
Oh, all the time. People just see the big number and get excited.
Exactly. The nominal rate is just the gross percentage on paper. But the real interest rate strips away the illusion. It shows how much a country truly rewards capital.
Right. So let's define the specific treadmills we are looking at today. In Brazil, the speed dial is the Selic rate, which is set by the Copom.
Right, the Monetary Policy Committee there.
Yep. And in the United States, that dial is the federal funds rate, managed by the FOMC at the Federal Reserve.
And then we have the backward motion of the belt, the inflation markers. For Brazil, the report relies on the IPCA, which is their broad consumer price index.
And for the U.S., we look at the CPIU, tracked by the Bureau of Labor Statistics.
Exactly. Now, to figure out your actual forward progress, you don't just take a calculator and subtract inflation from the nominal rate. The report uses the Fisher equation.
Okay, let's unpack this. The Fisher equation takes 1 plus the nominal rate, divides it by 1 plus the inflation rate, and then subtracts 1. Why do economists insist on this division method?
It seems overly complicated, right?
Yeah, I mean, if I have a 10% interest rate and 4% inflation, why can't I just subtract 4 from 10 and call my real return 6%?
Because simple subtraction is just a linear approximation. It ignores the way purchasing power actually compounds over 12 months.
Ah, so it's about the compounding effect.
Precisely. Your interest isn't just growing on your principal, it's growing on top of the interest you earned the previous day. And inflation is simultaneously degrading both your principal and your interest.
Ah, I see. So the erosion is compounding alongside the growth.
Exactly. If rates are tiny, like 1 or 2%, simple subtraction is fine for back-of-the-napkin math. But with double-digit nominal rates, it totally distorts reality.
That makes total sense. All right, now I want to look at the methodology this report uses because I found this highly debatable.
Ooh, the trim sample.
Yes, the report examines 20 years of data from 2006 to 2025. But they took all that data and just tossed out the four most extreme years, 2019, 2020, 2022, and 2025.
I know it sounds suspicious at first.
Doesn't throwing out the extremes just manipulate the data? It feels like cheating to make the historical curve look smoother than it actually was.
I completely understand why it feels like cherry picking. But statistically speaking, using a trimmed mean is actually the more rigorous approach here.
Wait, really? How so?
Think about what happened in 2020, one of the years they removed. We had a once-in-a-century global pandemic.
Right, supply chains just totally froze.
Exactly. The Fed slashed rates to near zero in a panic, but inflation hadn't spiked yet because nobody was leaving their homes. That created a massive temporary anomaly.
So if you leave that kind of black swan event in the data set,
It pulls the historical average so far out of whack that it no longer represents the true structural baseline between the U.S. and Brazil.
all right, I can accept that. We are trying to find the signal through the noise of crises. So, looking at that filtered sample, the historical average spread is 5.48 percentage points.
Yes. Historically, Brazil pays about 5.5 percentage points more in real inflation-adjusted terms than the U.S. Keep that number in mind. That is gravity.
Okay, 5.48 is our baseline. Now, let's look at April 2026. The Selic rate in Brazil is sitting at a hefty 14.75%.
Right.
And the IPCA inflation over the last 12 months is 4.14%. When you run those through the Fisher equation, Brazil's real interest rate is an absolutely massive 10.19%.
That is an incredibly heavy real yield.
Let's let that sink in for a second. 10% after inflation. But then you look north of the United States, the Fed funds rate is 3.75%.
And U.S. CPI inflation is stuck at 3.30%.
Right. So applying the Fisher equation, the U.S. real rate is basically non-existent. It's a minuscule 0.44%.
Which means the current spread, the gap between the real return in Brazil versus the U.S., is 9.75 percentage points.
A 9.75 point gap when the historical average is only 5.48. That is 4.27 points above normal. It's staggering.
And the report notes this gives it a z-score of 2.53. Wait, a z-score of 2.53. For those of us who haven't taken a statistics class recently, that means this is a once-in-a-generation anomaly, right?
Exactly. A z-score just measures how many standard deviations a point is from the mean. Most normal economic behavior falls within one standard deviation.
So a 2.53 is way out there.
Oh, absolutely. Once you cross a z-score of 2, you enter the top 5% of historical extremes. A 2.53 puts this in the 99th percentile.
Wow. Okay, so we've established the math and that the gap is historically massive, but capital doesn't just move because of abstract math.
No, it moves because of real-world friction. Fear, greed, policies.
Here's where it gets really interesting. Let's talk about the geopolitical and domestic forces driving this. The report details 6 key intertwining drivers.
Right, let's break them down. First, you have a deliberate policy of monetary convergence in the U.S. The Fed has aggressively cut rates by 175 basis points since late 2024. But in Brazil, the central bank has kept their foot firmly on the brake pedal. They hit a peak Selic of 15% in 2025, and cuts have been highly cautious.
Exactly. When one country cuts and the other holds steady, the gap automatically widens.
But why is Brazil holding steady? That ties into the next driver, geopolitics and inflation. The report specifically points to the Middle East conflict, which pushed oil over $100 a barrel.
Which is a massive factor. Oil is the lifeblood of global transport. When it spikes, U.S. inflation gets incredibly sticky at that 3.3% mark.
But how does a conflict across the globe dictate the interest rate spread between Washington and Brasilia?
Because global commodities like oil are priced in U.S. dollars. If the dollar stays strong because U.S. inflation is sticky, then Brazil effectively imports that inflation.
Ah, right, through the exchange rate.
Exactly. If the Brazilian real weakens against the dollar, that $100 barrel of oil suddenly costs vastly more in local currency.
Which drives up gasoline prices in São Paulo, which drives up truck delivery costs, and then food prices spike. It's a whole domino effect.
Precisely. So the Brazilian central bank is forced to keep the Selic rate punishingly high to attract foreign capital, defend the currency, and fight off that imported inflation.
That is fascinating. It's essentially a defensive maneuver, but it's not all global, right? There are domestic crossfires at play here, too.
Oh, absolutely. The report digs heavily into fiscal premiums and sovereign risk.
Right. The central bank's focus survey shows top economists are projecting inflation for 2026 to hit 4.86%.
And we have to view that against the central bank's absolute tolerance ceiling, which is 4.86%.
So the market is projecting inflation will literally bust through the ceiling. The report calls this unanchored expectations.
Yeah, and think about it from the perspective of an institutional investor.
If the government's own economists say they'll miss the target, I definitely demand a much higher interest rate to leave my cash there.
Exactly right. They demand a risk premium. And that demand is amplified by domestic fiscal dynamics.
Meaning anxiety over Brazil's fiscal framework and rising public debt costs.
Right. And in a cruel twist of irony, those rising debt costs are mathematically amplified by the massive 14.75% Selic rate the central bank is using to fight the inflation.
It's a vicious cycle. The medicine makes the underlying condition more expensive to manage. Which brings us to the carry trade.
Ah, yes. The defining mechanical engine of global capital flows.
The expected exchange rate is hovering around 5.25 Brazilian reais to the US dollar. Walk us through how this carry trade actually works.
Okay, imagine you manage a massive hedge fund in New York. Because of U.S. rate cuts, you can borrow $1 billion at a low rate, say 4%.
Okay, borrowing cheap.
Then you convert it to Brazilian reais at that 5.25 exchange rate and park it in Brazilian sovereign bonds, earning that massive 10.19% real return.
So you capture the huge spread without actually producing any real-world goods?
Precisely. Capital is agnostic. It simply flows to where it's treated best.
But the report hints that this carry trade actively sustains the high rates because when all these hedge funds dump billions into Brazil to chase yield, they have to buy reais.
Which props up the value of the currency, helping the central bank fight off that imported inflation. But there's a hidden danger here.
Currency fluctuation, right. Because eventually, that New York investor wants their profits back in dollars.
Exactly. If the real suddenly loses value against the dollars, say it slips from 5.25 to 6.00, it costs them far more reais to buy back their dollars.
Which could completely wipe out the 10% yield they gained on the bonds.
It is a high-wire act. If fiscal fears trigger a currency sell-off, foreign investors rush for the exit, crashing the currency and forcing the central bank to hike rates even higher.
So what does this all mean? Let's play a game of what if. We have this towering 9.75% gap. What happens if gravity takes over and pulls us back to that historical average of 5.48%?
The report actually runs the algebraic projection on this and is quite revealing.
Okay, let's walk through it.
We assume the spread compresses back to 5.48 percentage points. We assume U.S. real rates stay at 0.44%. And we assume Brazilian inflation hits that expected 4.86%.
So if we plug all those assumptions back into the Fisher equation and run it backward, the implied Selic rate would be 11.07%.
Exactly, 11.07%.
Wait, the current Selic is 14.75%. That means the implied rate is 3.68 percentage points lower.
This is the most crucial strategic insight of the entire report. It proves the current environment is intensely restrictive, but implies profound room for rates to fall.
Assuming domestic fiscal risks stabilize and external shocks subside, of course.
Right, which is a very heavy if. But the math dictates rates could drop by over 3.5% just to hit equilibrium.
Here's where it gets really interesting, because I want to leave you, our listener, with a final provocative thought. We've dissected how this rate is a magnet for foreign capital.
And a shield against imported inflation.
Right. But think about the domestic entrepreneur in Brazil right now, the local factory owner who needs a loan to expand, or the young family trying to buy a home.
A 10% real interest rate is incredibly heavy for them.
It's like applying a tourniquet to the economy to stop the bleeding of inflation. Yes, it saves the patient in the short term, but if you leave a tourniquet on too long, the local businesses get starved of oxygen.
That is a very stark way to put it.
How long can domestic industry sustain that crushing weight before the internal economy forces a breaking point? At what point does the cure become as dangerous as the disease?
A vital, deeply human question that the math alone cannot answer.
Huh.
And before we close out our analysis, as strictly required by the source material, I must carefully deliver the following mandatory disclaimer.
Go right ahead.
This material is a compilation of open projections and information from third-party sources and is strictly for informational and educational purposes. It does not present any ideological bias. It does not constitute an investment recommendation or financial advice of any kind. Projections are subject to frequent revisions based on new information, external events, and emerging narratives. Likewise, past performance is no guarantee of future results. All public data used was verifiable up to April 29, 2026, and any future official and statistical revisions would require historical recalculations.
Thank you for that. And thank you to you, the audience, for joining us on this deep dive. We appreciate you taking the time to unravel the structural mechanics of the global economy with us. That was today's Macroeconomy AI. We'll leave it here. You all stay well and keep an eye out for our new broadcast. Subscribe to our channel, access the links, and follow Macroeconomy AI on social media.
Bye.